Business Today's managing editor Siddharth Zarabi spoke with top economist D.K. Joshi from CRISIL and Ranjani Saha of CARE Ratings to decode the policy fine print and to find out what the extended pause on rates means for home loan borrowers. How soon can one expect a rate cycle reversal?
One question which I think is top of mind now, what really has the RBI done today apart from maintaining a status quo? Basically, have they dampened and pushed away any rate cut hopes?
Well, I think I would say so. The main objective, I think, of this policy was to take the pause forward, and I think that's what they did. I think one more addition, nuance that they added to this policy was that they made it very explicit that they are chasing inflation target of 4%, and they want to align the inflation to the target that I think they have been saying they want over the medium run. So that I think makes it very clear that they are not in a hurry to cut rates. There is a risk of them slowing down faster. There is a risk of financial accidents, geopolitical issues. I think all those things they highlighted. And on top of that, I think despite a normal monsoon forecast from the Met, the risk of El Nino has not gone away. And even if the monsoons remain normal, I think their distribution over time, over geographies, cannot be predicted at this juncture. So that risk always remains. So they've highlighted that is a risk to, from an inflation perspective, I think, which they need to monitor very closely. I think apart from that, I think the messages were pretty straightforward on growth and inflation. Growth forecast, they did not change because the growth momentum that we are seeing in the current quarter is quite strong, and I think they have a forecast of 8%, so it is on track. So they kept the growth forecast unchanged.
Rajni, what do you think gives the RBI confidence in the manner in which they have emphasized the 4% target and the point that D.K. Joshi made as far as inflation is concerned? The reason I'm asking you this question is the southwest monsoon has arrived in Kerala, but a week late. We saw sort of different weather patterns, at least in North India, during the height of summer in the month of May. Given all of that, plus the global overhang, what really could have gone into RBI's emphasis on the 4% inflation target?
If you look at the average, that inflation number that they've given for FY24, they have very marginally reduced it to 5.1% from 5.2% that they had given earlier. So, and they have highlighted a lot of looming inflationary concerns. Like you highlighted, one concern is weather-related disruptions. We cannot completely, while IMD has given a projection of normal monsoon, we cannot completely ignore the risk of El Nino. So that's something which RBI would be conscious of. Second, like RBI has highlighted, they are concerned about any other global supply constraints which could again push up global commodity prices. So given these uncertainties, RBI has preferred to, while they have maintained status quo on rates, if you look at the stance, there was some expectation in the market that probably they would move the stance to neutral. But they have maintained removal of accommodation as the stance because RBI wants to give the message to the market that they are still very cautious on inflation front, and they would like the market participants also to remain very cautious on market front, on inflation front. And in fact, not just RBI, globally, if you see, the central banks are indicating that they are going to be very flexible and they are going to be very data dependent. So they are not giving very clear forward guidance.
This concerns a lot of our viewers, which is what happens to deposit rates. And it's not directly, I mean, in some ways, the question is not directly linked to the repo rate status quo, but to do with the 2,000 rupee currency withdrawal and the impact on banking liquidity. What's your own sense about deposit growth and whether savers can now expect lower or flat savings rate for their deposits?
Because its policies stance is withdrawal of accommodation, they will not let the excess liquidity accumulate in the system, and they'll try to bring it down to near neutral levels. So I think all this, and I think Governor also had pointed out that it will work both ways. I think if liquidity becomes less, then they will infuse. So they would basically, I think, try to keep the liquidity in line with the requirements of the economy. But at least in the near term, I think that should create some downward pressure on short-term interest rates. But let's see how it plays out. Right now, the yield curve is completely flat. Whether you have a 1-year government bond or a 10-year government bond, the rate of return that you are getting on them is exactly the same, which essentially actually is pointing that maybe going ahead you will see rate cuts. I think that's what the yield curve is telling you about. So I think from a consumer's perspective, I think I would say the deposit rates have probably peaked, and they would not go beyond this. And going ahead, I think they're likely to stay at these levels for some more time before I think they start softening.
Rajni, would you agree with that, the point made by DK Joshi that deposit rates have peaked?
May go up a little more as the pass-through has not completely happened. But more or less, I would agree that it has peaked. And given that we are not looking at, we are looking at the RBI maintaining status quo, it's likely to remain around these levels, the deposit rate.